G'day folks, welcome back to another update for gold and silver. Now the charts are showing both a long-term bullish momentum, but do watch for that pullback. We're also going to include backtesting, which demonstrates how you could have traded using one of two strategies. So don't forget to hit that like and subscribe button to support the channel. In terms of the outlook, first off for gold, after reaching a record high of 3,411 per ounce in early May, gold experienced a slight decline of 0.5% by month's end, settling at 3,288. Despite this pullback, it boasts a year-to-date gain of 25.1%, outperforming the S&P 500's 0.5% return. Investor sentiment remains cautious amid fluctuating US-China trade relations and ongoing geopolitical tensions, prompting continued interest in gold as a safe haven asset. Silver prices have lagged behind gold, maintaining a historically high gold-silver ratio around 100 to 1, indicating potential undervaluation. Factors such as silver's industrial demand, especially in renewable energy and electric vehicles, and persistent global supply deficits suggest a bullish outlook. Analysts forecast silver prices to reach $38 to $40 by the end of 2025, with some predictions as high as $46 to $56. Looking at silver. So first we look at silver. And the long-term trends are showing bullish momentum on the price and also the CCI above the moving averages. So that's our bullish momentum, and it has been drifting across this diagonal ascending trend line for some time. On the weekly, we do have this bullish movement on the price above the moving averages, but note we did have this bearish divergence, lower highs on the CCI versus higher highs on the price, and that eventually dropped and hit into our minimum target range, that 23-38% range. And for those new to the channel, we draw that Fibonacci to measure that retrace. We take it back to a significant low. That would have been around that point there. That's at 23-38% range. So it sort of fluctuated in that range for a number of weeks before bouncing out of there. But notice the CCI is still dropping, with making some little false breaks above on the CCI, with the price also moving higher. At the moment, we've got a fresh breakout to the upside on the CCI, so fresh movement on the weekly to take long positions, and I'll show you the back testing in a minute. Looking at the daily chart for a minute, let's zoom in. It's been trying to break through this resistance at 34.59, and it's still struggling to break through there. So at the moment, you'll notice today it's a bearish candle, even though the CCI is higher, and so is the price. So giving us bullish momentum at the moment. And again, for those new to the channel, these moving averages are available in the description below for a different video if you want to reference that. Now, taking long positions only, we look at the micro level, and here we've got the 1 hour chart. So we take long positions based on the daily. So what we first look at is there any divergence? Now, you can see there, you could probably argue that was a divergence, that those tops there on the CCI, versus the same period we had higher highs on the price. So flat top on the CCI, or almost like a triple top if you like, versus high highs on the price, and that pulled back to our minimum range easily. So if I draw a Fibonacci between there and to there, and I typically take it back to the previous low before the divergence started, you can see it's currently fluctuating around the 38% level. So our minimum target to be hit would have been that 23-38%, and it's hit it perfectly. Now, it could fall further, of course. The CCI is still giving us a bearish momentum, even though we've got a bullish candle in the current hour as we record this. The other thing I want you to notice is, if I just get rid of that Fibonacci, there's these fair value gaps. Now, what the fair value gaps are, for those not familiar, we take that candle, for example, we take the previous wick high, and the candle after that, the wick low, and that blue area there is called a fair value gap. Now what typically happens is, when we get that fair value gap, the price generally retraces into that range. You'll notice here as well, between that bearish candle, there's a fair value gap there. So we can expect the price at some point to break into there very soon, very likely. But having said that, we've got fair value gaps here, and the price may first retrace to the downside. There's no guarantee where it's going to go. That's why we follow the trend of the CCI. We follow the trends using that, and we only trade in the direction of the higher time frame, in this case the daily, if you're trading on the 1 hour. I suppose what I'm saying is just be careful. It's going to break into one of the two directions, and it most definitely will cover these areas on the short side, or break higher and cover that area on the long side. And those fair value gaps happen quite a few times throughout the period on all time frames. You can see here on the daily, we had a massive drop, fair value gap, that pink area highlighted, and the price retraced and covered all that area. Sometimes it might only cover 50% of it before retracing to the downside. In this case, it covered the 100% of those fair value gaps. And if I zoom in, there's a few little smaller fair value gaps in there as well. That one there was the last one. Notice that wick of that candle penetrated it and covered all of it before bouncing higher and closing higher. Now at the moment, for example, where we are here on the daily, if today closes higher than that, then this area here would be a fair value gap between the low of that candle and the high of that candle. That will be a fair value gap if this closes higher than this today. So again, just be mindful of that. At some point, we're going to see prices retrace to the downside, and that aligns with these fair value gaps here on the 1 hour time frame. So if we look at the back testing, let's go to the long positions. So again, we take long positions, and I've started the back testing here, the stop loss approach, the top one, and the profitability chart here is the average down approach. And I've started both back tests where the CCI broke above the moving average range in that period there around the 14th of April. So if you let the whole thing run through, and there's a $100,000 baseline on both accounts there, if you like. I'm not telling you you need 100,000. I'm just showing you that to allow for a drawdown below 100. You can see there the stop loss approach is currently closing at 99,400. So you're losing about $600 on that one. And the average down is generated 97,130, and that's because of all those multiple average downs. Now again, I'm not telling you to hold it throughout the whole period, because this could go, if this had dropped, this is long positions, if this had dropped strongly like it did back here, you would have had a lot stronger drawdown. So what we need to do is you follow this on the daily. When it breaks higher, that's where it starts there on both the stop loss and the average down approach, and you close it at the very latest when it breaks close to or into that moving average range around the 29th of April. You can see there that equates to this area here on the two strategies. So that's where you would have closed out the positions. It broke above there, a false break on the daily, and that would have been around this period. So you would have stopped out the trading on the hourly with that daily break below. So it would have been a false break, and you would have had a small loss there. And again, going long at that point there on the 20th of May, and that equated to this area here on the two strategies. So again, had you let it run, you would have closed out the positions when it broke into the moving average range on the daily about there. So again, I'm just demonstrating how you would have avoided having these drawdowns on both the stop loss approach and the average down approach. Looking at gold. So gold on the long-term trends is very bullish. Nice big move above the moving averages. We're not seeing any CCI drawn for it on the monthly. On the week, we did have this nice bull run as well, but notice we've got a bearish divergence. And I've drawn a target area for that already. So we expect it to break down. The CCI is falling off from where it was there. That's a very long-term bearish divergence. The CCI has dropped off and looks like the price is struggling to make new highs. So you might see it break, or we very likely should see it break into that 23-38% range. We had another smaller bearish divergence here that already hit it. You can see they just kissed it and then bounced out of there. And it may well do the same here. But do note as well, this is the weekly chart. We had these fair value gaps there. So that one, see back here, they were all filled with these price movements. And more recently, that was the more recent one there, that was filled with that wick of that candle. It was filled about 75% of it. This one was also filled about 50% of it. And then these two more recent ones were also filled with the action of these candles and wicks as well. So they've already completed on the weekly. But again, on the divergence side, with the bearish divergence, we expect it to break into that minimum range. If we go to the hourly chart, again, the CCI is still dropping off, even though it's bullish at the moment. The price is struggling to break new highs, and we've got this other bearish divergence versus higher highs on the price. And again, we've got this is a longer term one, similar to that very long term. We've got another target range down there, but in this little range here, I haven't drawn a target for it, but let me do it now. So from that high, we take it back to the low before that divergence started. So we'll take it back to that low. And the minimum retrace level, you can see it's already hit it. That's at 23-38% range. So it's already hit that range, and it could actually start rising. If it breaks through that resistance up there, then we may see further upside, and the CCI is already broken higher, so just be aware of that. On the intraday chart, the first thing we look at is any divergence, and this is not a divergence. The price is corrected and broken to the downside. The CCIs are also showing a slight bearish momentum in a very short term. Back here, I'm not seeing any other. So back here, the last divergence we had was a bearish divergence back here, lower highs versus higher highs in the price. That broke down our minimum target range. And since then, the price has been moving in alignment with the CCI, which is what we normally want. Now, because the daily is predominantly in a downtrend on both the CCI and to some degree the price, we're going to take short trades only. So don't take any long trades. So we look here on the short positioning, on the stop loss approach and the average down approach. And I've started it back here on the stop loss and average down from that point there around the 25th of April, when the CCI broke below the moving average range of the CCI. Now notice the price was still above. It's a bit risky, but that was giving us an early warning that the price was going to retrace, which it did. And had you taken those trades, overall, had you let the whole period run, and I'm not suggesting you do that, you would have closed it out the first time at that point there, went around the 6th of May, and that equated to around this period on the stop loss approach and the average down approach. And you would have got in again at the short position again when it broke down on the 9th of May. So, but again, I'm just demonstrating how you get in and out and letting these programs run throughout the whole period. So the stop loss approach would have generated about $860 odd, and the average down approach would have generated about $10,300, and still rising actually. Notice as well, we've got short positions here, so that indicates ideally you probably want to be closing out your short positions. Notice the profitability has dropped off, so you don't want to get caught out with if the price keeps rising from there. So that's why you always follow the higher time frame, even though the shorter time frame is showing a short position. So always follow the higher time frame trend. So that's the gold short positioning backtest. If you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.